So we are live.
Okay, let's just wait to participants to add. Okay, I think all have joined. Let's start. So, good morning. Welcome to Swagatam, this fortnightly market outlook webinar. I am Devarsh. I am joined by my two colleagues, Subash and Nagaraj. Good morning, Subash.
Good morning, everyone, and good morning.
Yeah, Nagaraj, how are you doing?
Yeah, fine. Good morning, everyone. Welcome to Fortnightly Market Outlook webinar.
Okay. So, during this next 30 minutes, we aim to share the global market outlook, the local developments, and the perspectives from technical and derivatives data. So first, I'll speak, then I'll hand it over to my colleague Nagaraj, and then he will hand it over to Subash. Nagaraj will speak from a technical perspective. Subash will share his insights from derivative. And in the end, we'll try to bring everything together and share the outlook for you. So without further ado, let me start. So this is the happening of the market. As many of your regular viewers know, the markets were correcting last month. From April to May, we have seen markets rebounding. Other than Chinese market, most of the global markets are up now. We have underperformed compared to global markets like Dow and S&P, and even European markets and Japanese markets are up about 9 to 12%, while we are up about 6%. So in this rebound, in last 1 month, we have rebounded about 6 to 7%, but that is lesser compared to the global markets because these markets fell quite dramatically and they have rebounded also. Now, if you can see from the screen, on the April month when we did our webinar, we saw that the US markets were down about 15 to 20% from their all-time highs. Now, as we look today, they are down about 8 to 10%. The reason is that they go up in tandem and they go down because of the huge amount of passive investments which are there in US markets. Everybody owns almost similar stocks. So S&P 500 stocks, when they get the passive inflows, all of them fall if the money is withdrawn. If money is back into the ETFs, all of them rise together. What are the important economic developments? So first and foremost, the important development is the US GDP. And the number which we saw for this quarter was minus 0.3%. So after series of good growth in US economy between 2 to 3%, even 4% during this series of positive growth, latest quarter numbers are negative. Is it worrying? No, it is not worrying. It is not challenging. The reason is this. The GDP numbers are calculated using few variables. Variables are obviously the consumer spending, the investment, government spending, and net exports. The reason why we see this negative number is because of the imports. Huge amount of front loading was done by US businesses in anticipation of tariffs starting in April. So they imported much more than their requirement, and that's why import number is huge. And because of the import number is huge, this GDP number is becoming negative. We don't expect this kind of large import numbers to come in next quarter, and that means the GDP will rebound. Usually the technical definition of recession is that the 2 consecutive quarters of negative growth. We had a negative growth in this quarter. Is it likely that US is going into recession? The chances are increasing. We are fearing that US may go into recession, but it is not now. Next quarter, it is likely to be a positive number. Why it is likely to be a positive number? Because the labor market in US is still very healthy. As you can see, the non-farm payroll or the new jobs, still about 200,000. So about 2 lakh jobs are still being added into that market. The unemployment numbers are not rising, it is steady. And that means labor market is supporting. Few quarters down the line, if they are not able to do the trade deals, if they are not able to reduce the uncertainty which is there in the market, and I showed the uncertainty chart and other details in the last webinar, and we had a detailed discussion about trade war, so I don't want to get into those details, but we expect them to rebound next quarter. What will be the India's attitude? So our approach is that we are going to do a trade deal. We had a huge deficit because of IT and pharma. We are going to increase the defense purchases. We are going to increase the energy purchases. A lot of LNG is going to come from US, and that's why we are going to circumvent the wrath of US administration. We are reducing the tariffs. India may be one of the first country which will have a trade deal with US. And not only US, India is going to do trade deal with UAE, Australia, Europe. All these are likely to happen over the next few months. And that is likely to support our import-export and our share of the global trade. So that's the one positive. Second positive is that during the correction, retail investors did not budge. They continued their faith. There was some tapering off of the numbers, but still net positive numbers. That means DII has the firepower. In fact, local mutual funds have now among the highest cash, about 6% cash in their aggregate portfolio. So if there is a larger drawdown, markets will be bought by retail, the domestic institutional investors. So one side is now very strong, which is DII. In fact, last year, FIs sold heavily. 1.27 lakh crore worth of stocks were sold by foreigners. Compared to that, about 4.69 lakh crore were bought by domestic institutional investors. That's why DIs are now becoming stronger compared to FIs. Their role is becoming more, and they are becoming more influential. At the aggregate level, they own about 15.4% of NSE 500 compared to 13.4% by FIs. So gradually DIs are owning more in the percentage term. So smaller companies, they own little larger chunk compared to FI. FI still own little larger chunk of large companies. So on value terms, they own about 19% of the NSE 500. FIs own about 18.6%, and DIs own about 19%. So DIs are very strong, and they are going to increase their influence on Indian markets. So what is the outlook in short? My colleagues will share the details about the numbers. Let me share it in detail. We were bullish going into the April month. We gave a clear-cut reasons. FIs were heavily short, DIs were buying, the economic numbers were strong. In fact, the March, the GST numbers, recent GST numbers were at an all-time high, and we foresee all this, and we clearly gave you a bullish outlook. So the Nifty bounced back from 21,743. 4th of April, we saw this low, and now 13% rise in Nifty on back of banking. Banking was our preferred sector. About 14% rise in banking led to about 13% rise in the overall Nifty. Now we are expecting sector rotation. Huge gains have been done. We have now need to digest these gains. New leaders will emerge in the rally. Banking will consolidate. We expect, because dollar is so weak, you can see the rupee. Rupee has appreciated from 88 levels to almost 84 level and rebounded yesterday. In fact, if you are a loyal listener, you remember that around 88 levels, we saw that we are unlikely to see 90, but we will see 86 first. If you remember that, we were clearly bullish on rupee. One of the contrarian or variable call was different than the street was that we are expecting money to come in through the debt market. Huge amount of money we were expecting from foreigners into debt market. that should lead to appreciation of rupee. That call has worked out. Rupee has appreciated, and now it has reached to a level where we are more or less level where RBI will not let it appreciate much. So now IT stocks should breathe a sigh of relief. Commodities which are denominated in dollar should start performing. New sectors which are showing signs of becoming leaders are cement and sugar. Mostly these sectors will now lead. Rotation should happen. Market should digest the recent gains. Mid cap and small cap should also digest the recent gains. FIIs have covered their short and they have become large buyers. As I've shown in the figures, rupee has appreciated on back of flows into the domestic debt market as well as the equity markets. What are the challenges? Why we do not expect a large another 13-14% rally in the month of May? Because the risks are rising. What are the risks? Two risks are there. Obviously, everybody know the Pahalgam attack. Geopolitical risks are rising. Another legal uncertainty which has come yesterday and which is a very bad judgment from Supreme Court. JSW's resolution of Bhushan Steel and Power, which is the base on which a lot of resolutions happened. The IBC IBC was considered one of the success. Now has been considered illegal. They have ordered liquidation. This will go into further litigation. This is a very large negative news flow from Supreme Court into the PSU banks and especially the whole NPA resolution process. So this is a new challenge and law will take its own time. Ultimately, we expect that this judgment of Supreme Court should get reversed. We will see opinion from legal experts, but our expectation is that this is a negative for banking. Another big negative is the geopolitical tensions between India and Pakistan. Market right now is not discounting any war, any geopolitical uncertainty. It is our belief that we should not try to predict when will it happen, whether it will happen or not happen. We should prepare. Rather than attempting the unpredictable, prudent approaches to have a strategic preparation, create a portfolio which is resilient, create some cash in the portfolio so that if there is a surprise event, if there is some geopolitical flashpoint arises, we are prepared to take the benefit of that fall. What will be the event? How severe that event will be? What will be the repercussion on different sectors? It is unknown. Nobody knows. We should try to prepare for this event. It may happen anywhere between now to November, December. And as and when that happens, if it is a large event, if there is a large drawdown, we should be able to buy back into that uncertainty. So keep that dry powder in the portfolio. That is what I wanted to share. Now, let's look at the markets from short-term perspective. I'll invite my colleague Nagaraj to share levels from technical perspective. Over to you, Nagaraj.
Thank you, Devarsh. Is my PPT visible?
Yes, go ahead.
Yeah, friends, good morning. Welcome to Fortnightly Market Outlook webinar. As Devarsh mentioned, the other things will now look into the technical aspects of the market, how market is placed. Without wasting any time, we'll look into the slides. This is the daily chart. Friends, what we can observe over in the daily chart is that market has been moving in a larger range movement over the last 7-8 sessions. Very severe selling has happened from the higher levels. on Friday, and market has absorbed the selling at the lower levels, stood firmly. What it is indicating, display of high volatility due to rising geopolitical tension between India and Pakistan. We have seen some significant upside momentum from the lower levels, as Devarsh mentioned, from 21,700 odd levels to around 2,800 points rally. We have seen continuous rally in the last couple of weeks, 2 to 3 weeks, without showing any reasonable downward corrections during this period of time. We have seen 1 day of correction. Immediately after that, market has bounced back. So net to net, we can say after the formation of the important bottom reversal, a double bottom of kind of a pattern or a slightly lower bottom, market stood firmly, witnessed a significant reversal, bottom reversal from 21,750, 800 levels and placed at the higher levels. You have seen some significant gains over the period of time. Now, what the market is placing at the highs. Currently, the geopolitical tension is weighing high on the market. We will see how things pan out. Previously, how this geopolitical tensions have impacted in the market in the next slides. So the current pattern is market is facing resistance around 24,500 to 600 levels and is not willing to come down, at the same time feeling pressure at the higher levels. Friends, this is the Nifty backdated daily chart. As I mentioned, the retaliatory of the surgical strike announcement has happened in 28th September 2016. So this is the circle, this marked area is the day when there was an announcement from the Defense and Foreign Ministry from the Indian side that they have done the surgical strike on 28th of September 2016. At that time, market has declined sharply. This long bear candle is indicating that in 28th of September 2016, market has declined sharply after the announcement on the tension of the geopolitical impact, and market on the next day, it has bounced back. Over the next 2 to 3 days, after the decline of 1 day, market has bounced back sharply from the lower levels, and after that, it continued its trend. As we have seen in September 2016, market was made a lower highs. After that, it has started to come down. During this period, this event has happened. After that, 1 day decline has impacted on that event. After that, market has upside bounced back strongly and later continued its trend. So this is the geopolitical tension of the surgical strike on 28th of September. So this is Balakot strike. So impact of geopolitical tension between India and Pakistan on the markets in the past, which is a Balakot airstrike on 26th of February 2019. So friends, this is also a backdated chart. On 26th February 2019, India carried on airstrike on Balakot. And we all know that all. I don't want to discuss, prolong this one. But on that day, market has fell down sharply. It has recovered significantly from the lower levels. This arrow mark is showing a reasonably long bull candle with higher and lower shadow, which is indicating on the announcement, the market has dipped down, declined sharply, and later on moved up in the very good momentum, closed at the higher levels. After that, after the announcement of 1 or 2 days, market has witnessed some volatility. Then eventually this volatility has taken into a very good upside momentum for the market, upside rally for the market in March and April 2019, where Nifty has headed a clearly higher after 2-3 days of the surgical strike, air strike, and market clearly moved up. So we have seen the two indication. One indication, market has declined for 1 day. It has recovered in the next day. In another indication of the Balakot strike, market has declined on the intraday and recovered significantly from the lower levels on the day itself. After 2 days of correction, it has moved up. Now, friends, we are all fearing. We have seen market Nifty is facing resistance around 21, 24, 500, 600 levels. We are all on the fear that now this geopolitical tension has once again escalated, and there is a fear that if there is something happen, if India retaliates, what is going to happen on the market? So in that last two occasion, even I didn't show the slide of the Kargil war. Kargil war also, at least we have seen some short-term knee-jerk action. After that, it has moved up continuously. So we have done very well from the lower levels. We are placed at the higher levels. Logically, technically, the downward correction is due Currently, though market placed at the higher levels, this is the weekly chart. Long bull candles have been formed in the last couple of weeks, but the higher shadow can be observed. The higher shadow on the technically indicates that there is a selling pressure from the higher levels around 24,500, 24,600. Market is reversing from the higher levels. At the lower levels, market is holding up. So on that front, we are saying that even though emergence of selling pressure at the higher levels, I'm not expecting any bigger reversal point confirmation at this point of time. Though market placed at the higher levels, though market seems to are tired at the higher levels, we are not seeing any confirmation of any significant reversal point, reversal pattern yet at the higher levels. So within that broader range, the immediate support, the strong support is seen around 24,000 and 23,850, 800 odd levels. Friends, this is the long-term charts. What we can observe in the long term after taking the support around the 21,700, 22 levels, couple of occasions in the couple of months, the support has been violated in the last month. It has been clearly violated and market bounced back. This is as per the long-term chart, indicating some bullish bias, formation of some important bottom reversal, and recently Nifty has witnessed the upside breakout of the monthly range and moved into new swing highs. Currently placed at the higher levels on the long-term chart, the trend remains up. We can say on the move above 24,600 level, which is a resistance, Nifty could open the next upside of around 24,800 to 25,000 levels in the short to near period of time. What we can observe on the broader market front, though broader markets are underperforming a bit compared to the benchmark 50 recently, this is the mid cap, this is a small cap. On the weekly chart, what we can observe, the smaller body candles with long lower shadow. Same thing in the mid cap, and the similar kind of a pattern in the small cap as well. That is indicating these broader market indices showing some signs of weakness at the higher levels, but still it is been coming down from the higher levels. Still, there is no indication of a significant decline weighing on the broader market front. So I'm expecting a slight of underperformance is likely to continue compared to Nifty. Nifty and Bank Nifty are relatively strong compared to mid and small cap. There is a possibility of, I'm not expecting any bigger decline, bigger sharp reversal from here onwards. Some more consolidation. Yeah, minor decline is likely in the mid and smaller cap segment. Later on, it could move up and bounce back from the lower levels. So the Bank Nifty, nothing to mention about the Bank Nifty. We all know that Bank Nifty has been outperforming the broader market, currently placed at the higher levels. 56,000 is acting as a strong resistance for the Bank Nifty. Coming down, a smaller candles on the weekly chart is indicating there is a selling pressure indeed, but the Bank Nifty is not showing any reversal pattern. The uptrend that has started from the 48,000 levels has not yet reversed at the 56,000 level, though there is some selling is coming. So I'm expecting over the period of time, we could see upside momentum in the Bank Nifty as well, and this resistance could be overtaken over the period of time. So the conclusion is the market outlook is the upside momentum continued in the Nifty for the fourth consecutive week. Last week, Nifty gained this week by 1.28%, and we closed the week higher. Nifty is currently showing volatility at the higher level on the backdrop of geopolitical tension. Resistance is placed around 24,500, 600 levels. At the same level, we expect Nifty to find support around 24,800. Nifty to find support around 24,000, 23,800, 850 levels. Once it breaks about 24,600 levels, the hurdle, the next resistance could come in around 25,000 to 24,800. Quite a strong upside momentum would continue once Nifty breaks above the hurdle. Friends, we have seen there is geopolitical tension is looming. We have seen surgical strike, Balakot strike, how it has impacted to the market. And market, I'm reiterating that market could could show some knee-jerk action post the impact, post the event, but eventually it could bounce back from the lower levels. So our mantra would be the buy on dips opportunity. Once it breaks above the hurdles, one can look to go for a long positions, and it comes down, market comes down, one can look for a buy on dips opportunity around 23,800 to 24,000 levels. The broader markets are showing some consolidations at the higher levels, and I'm not expecting any bigger decline. At the lower level, some more consolidation is likely, some more underperformance is likely for at least 1 week compared to the Nifty, and we could see some buying is going to emerge from the lower levels, and we could see some decisive bounce back in the mid to smaller cap segments over the period of time. Sectorally, banking, PSU banking, automobiles, oil and gas, pharma, realty, IT, CPSC are likely to outperform. Chartically, they are looking positive. There is a news on banking side. It could underperform a bit in a short-term period, but over the period of time, we could see some outperformances coming in these sectors as well. That's all from my side. Now I'd like to invite my colleague Subash to discuss on the Nifty as per derivative front. Over to Subash.
Yeah, thanks, Nagaraj.
Yeah.
Is my screen visible?
No, not visible. Your
You
screen
could
is
share it.
Okay. Okay, now is it visible?
yes, visible.
Good morning, everyone. So I'll be giving a brief outlook on the markets based on derivatives. So if we look at we will be looking at the open interest data. We'll be looking at the option data analysis. We'll also be looking at the FIs data. And we'll also look at the sector-wise open interest build-up. So these are the different data points that we'll be looking at. So coming to the open interest, there has been long build-up in the Nifty futures, 11.53% rise in open interest, with the Nifty rising by 1.28% this week. In the Bank Nifty, we saw short covering. So traders were covering their shorts, and there was a 3.98% fall in open interest, and the Bank Nifty rose by 0.83%. Coming to the option data, we are seeing call writing at 24,500 to 24,800. And puts have been written at 24,300 to 24,000. We can see the open interest chart. We can see here that there is maximum open interest buildup in the 24,000 strikes, which indicates that traders are not expecting the Nifty to fall below these levels in the near term. So that is a strong support as per the derivative data. And on the upside, we are seeing call writing at 24,500 to 24,600, as you can see on the chart here. And once that is crossed, then the next resistance is around 24,800 to 25,000. The maximum open interest in the call segment is in 25,000 strikes, which indicates that that is a very strong resistance. So upsides could be capped up till 25,000 for the near term. Then coming to the FI data, we have seen long build-up by FIs in the index futures segment. They net bought 4,836 crores, with open interest going up by 19,180 contracts. And if you have to see the breakup, there has been long build-up in Nifty futures, while unwinding of longs was seen in the Bank Nifty futures. In the stock futures segment, again, FIs were building long positions as they net bought 8,122 crores, and open interest increased by 1,30,398 contracts. So they have been building longs in both the index futures and stock futures segment. If we look at the FI long to short ratio, it has been steadily climbing higher, and it is now at 0.9. This is the highest since 24th August 2024, which is almost 1 year back. So that is a positive sign. It indicates that FIs are covering their shorts and also steadily building long positions. If we look at the sector-wise open interest data, there has been long build-up in the chemical sector and oil and gas, pharma, and also realty. Short build-up has been seen in cement, FMCG, power, and telecom sectors. So this indicates that going forward, it will not be a broad-based up move. It will be more of a stock-specific action, and one will have to focus on the outperforming sectors where there has been long build-up, like chemicals, oil and gas, pharma, and realty. These sectors one could focus on for the near term. So coming to our outlook, we have seen long build-up in the Nifty futures, long build-up by FIs in the index futures segment. The rising FI long to short ratio also gives a bullish outlook for the markets because they are covering their shorts and building longs. And the open interest data indicates healthy put writing at 24,300 and 24,000 levels. The maximum put writing at 24,000 strikes indicates that traders are not expecting Nifty to fall below 24,000 in the near term. On the upside, Nifty could rise up to 24.5 to 24.6 in the short term. And once it crosses 24.6, the next target is 24,800 to 25,000, where there is currently maximum call open interest. Bank Nifty also is looking bullish and could rise up to 56,000 to 57,000 in the near term. And one can keep a stop loss at 54,000, where there is healthy put writing. That's all from my side. Now, over to Devarsh Bhai.
Is my screen visible?
Yes, it is visible.
Yeah, okay. So conclude, as I mentioned, we expect markets to be range bound between 24,000 to 25,000 in the month of May. Some uncertainty, which as discussed by my colleagues, geopolitical as well as the FIs, which were the catapulting the market higher because they were extremely short and we were confident that they will have to cover their shorts. Now, more or less 0.9, that means they have more or less covered their short. Now, there is no ammunition for new shorts to come into the market. Once the consolidation is over, positive news comes, then we will expect the breakout. Now, coming to our performance, one of our fundamental flagship product is the pick of the week. So as you can see from the screen, we gave stocks within the with different industries. Whatever we gave on the month of February and March, we saw that there was a rally and all of them either have achieved their second or first target. On an average, from the 1st of January, since we started our prime research division, whatever we have given on an average, they are up about 11% aggregate compared to about 7% correction in mid cap and about 14% correction in the small cap from the 1st of January. These stocks fell little lesser when markets were correcting. They fell on an average 3% down on an aggregate, while markets were down about 10 to 15%. As markets rebounded from the lows, these stocks have risen much more than the market and they have given fantastic returns. So if you are looking for investment ideas between 6 months to 9 months to 12 months, have a look at pick of the week. Every Monday morning, we issue one new stock and we expect about 5% of your long-term capital should be put into these stocks. And on average, you can have about portfolio of 20 stocks and then keep it rotating, churning. As some stocks achieve their target, first target, you can liquidate 50% of the capital which you have put in. By second target, you can liquidate the full amount and keep it in the cash so that when the new idea comes, you can invest in new ideas. Similarly, one of our focus areas, MTF, we gave 35 new calls in the short term, 29 were positive, 8 were negative, 78% was the success ratio, 2% was the average return, and ROI was about 5.2%, assuming that you brought in a cash to keep the margin. If you had give the stocks as a margin, then obviously you do not have to bring this margin and then you would have gained this much return on your long-term holdings. On positional side, about 4.7% for the 14 calls which we gave, 9 were positive, 2 negative, 7 are still positive open. So they, as the market moves up, these are likely to also move higher. So this is the performance of MTF stock, 5% absolute. If you bring in the cash, 14%. If you have just brought in your long-term hold portfolio and just gave that as a margin, then obviously you could have earned this extra return based on your long-term investments. So, good month. April has been a fantastic month. Those who have participated in the rally have made good money. Let's consolidate our gains. We are expecting market to remain range bound between 24 to 25. Different sectors will lead. We expect sectoral rotation. FIs have covered their short. Now we are expecting some kind of consolidation there also. That's all we wanted to share. Now, if you have any questions, we have about 5 to 7 minutes to answer your questions. Please share your questions. We'll be more than happy to answer whatever question you have. With so much cash, FI and DI, and no shorting in the futures, who is selling at higher levels in such big quantum and is able to stop market going up in last 8 days? The FIs are 1,200 different FIs. So large long-term FIs who bought heavily into the month of March, they must be booking profits. HNIs and other large investors, domestic, some mutual funds have been creating cash. About 6% cash is available with the domestic mutual funds. So Mukesh Gupta is asking, I think HNIs, some domestic institutions are selling, and that's why markets have not risen. Should client sell its portfolio because of India-Pakistan war? No, you never know. Yogendra Vyas is asking, so no, Yogendra, one should not sell off the portfolio. If large leverage positions are there, you should prepare for the margin. If the portfolio, long-term portfolio doesn't have a cash, then we should create about 5 to 10% cash. We should have some gold allocation, which will move contrary to equities. So some amount of safety, some cash, and some rotation into lower beta stocks should be done rather than selling off the portfolio. If there is an attack tomorrow, what's the downside on Nifty you see? Nobody knows what is going to be the attack, the kind of attack, whether it is going to be a bigger war or a smaller war. So we do not want to predict. Right now, data is suggesting that the markets are unlikely to go below 24,000. Markets are unlikely to move above 25,000. This 1,000-point range is what traders are expecting, what market data is telling us. In war, please understand that it is not certain the outcome. When Ukraine-Russia conflict started, many commentators who are in this field predicted that it will be a short war. It will be 2 weeks affair, 2 months affair. We have been seeing that the war has been dragged on for years now. So I do not want to predict that what will happen or when will it happen. Whatever happens, we should make our portfolio resilient, our derivative and our MTF positions light, so that we are open to face any challenges. That's how you should prepare. Bharat is asking, how should you prepare? Prepare by bringing little bit cash into the portfolio, generating little bit of cash, reducing your trading, extremely long trading leverage positions. Keep it light so that you can participate on the upside. If there is some downturn, you can also pay for the margin. We cannot answer your individual stock specific or futures position. We have a WhatsApp group. With the help of relationship manager or through our customer care, you can answer those. We will answer those individual questions. USD INR outlook is that it is likely to remain strong. We do not expect it to go back to 88 level, 89 level again. It is likely to remain between 85 to 82. The bias is towards appreciation. Once the US trade deal is done, if it is done, which most of the experts expect that within the 1 month, US-India trade deal should happen. By June end or July, India should again start being added into the global bond indices. We have been added into JP Morgan and Bloomberg. I am expecting that the FTSE may add Indian treasuries into global bond indices, India. And if that happens, another round of new flows should come into Indian markets. And that's why we have been expecting that the cost of capital in this country should go down, and it is happening. The 10-year treasury has moved from 7.4 to 6.4 or lower levels, and that is likely to support Indian markets. We will be coming out with different sector stocks. So in IT, as I showed, we gave Zensar as one of the big. Am I audible?
Now you're audible. The connection was lot in between.
Okay.
Yeah, connection was lot in between.
There was some electricity. Yeah, anyway, so we will be coming out with different new pick of the week in IT, cement, and other sectors. Even Star Cement, given Zen, these are some of the picks which you can look at from cement and ITs. All right. Any sectoral suggestions? Yes, we like IT at low level. Banking may consolidate, but at lower level, again, we can look at bank stocks. Defense is one of the new themes. We have given Mazdak, we have given GRSC as a long-term investment. They have achieved targets to at low. Again, you can look at stock. Defense is going to be a big theme going forward. All right. I think we have answered most of the. So we have Telegram channel. We have on our app. You can go to the research dashboard. There all the recommendations are available. If you have any issue, you can always connect with our local representative, and we are more than happy to help you and sort out the problems. All right. Thank you everyone for joining. Thank you, Subash. Thank you, Nagaraj. I
Thank
hope
you.
this has been useful. Have a great weekend ahead.
Thank you, everyone.
We can post. Thank you.